Hey traders, in this video we're going to go ahead and review the NASDAQ, Facebook, and Apple, all of which were alerts in the futures room. Now, Facebook and Apple may not sound like obvious futures trading choices, but when you think about the fact that when you're trading the NASDAQ futures or the QQQ ETF, you're trading a collection of stocks. You know, we're just wrapping it up in the future sense with some margin, and you're trading a weighted, high concentrated weighted collection of stocks. Now, the big five, of course, your Microsoft, Apple, Amazon, Facebook, Google, and Goog, throw Tesla in there. And now you've got pretty much the only reason equities are rallying is because of just a handful of names. Now, I don't want to say the only reason, but back out those names from the broader averages, and we're not up that much on the year. So you really got to think about the high concentration weighting that has basically permeated passive investing, those ETFs that we love to trade and own so much, and also the indices. So what we do is we don't gripe it, we don't worry, we don't fret it, we just trade it. And that means that if the NASDAQ is giving us a pullback, there are going to be opportunities in the heavily weighted sectors and stocks to also play pullbacks. And that's why we ended up trading Apple and Facebook today. What else could we or do we look at? XLY, which I think is a terrific way to not only play one of the heavily weighted sectors of the NAS, but also Amazon, because Amazon is 25% of the XLY. A lot of traders can't buy straight up Amazon. A lot of traders can't trade even the options because they're in many ways very cost prohibitive to shorter funded traders and less experienced traders. XLY is a terrific way to sort of coattail Amazon. So think about the way in which we're not only playing the indices to sectors, but also reversing that and playing some of the stocks that are heavily weighted within the sectors and indices. And when you have that kind of fluidity, you're never going to be lacking for opportunity that's connected to the broader averages. So Facebook is an entry that we took at the value area low, a volume-derived support level, and Apple was a setup that we took at the 8 exponential moving average and the point of control. So not only are we combining price-based indicators like moving averages, but we're also looking at volume-based support and resistance by way of the volume profile, the V profile tool that I anchor to the beginning of the month and also the beginning of the year. So I will always have 2 volume profiles running. And there are plenty of places we can find opportunity at value area lows and points of control. But the bigger picture is, gang, I am going to continue to look at the long side of this market. I think Apple is a terrific example of just how little this market pulled back. Apple is unique among stock. I think you can throw Facebook in there, Microsoft in there as well, because of course it's weighted heavily within the NASDAQ and the S&P futures and indices, but it's also weighted heavily, both Apple and Microsoft, in the Dow. A lot of folks may not know or sometimes forget that the number one weighted sector in the Dow is tech. So Apple has weighting across all 3 of those indices. Now, look how little Apple was willing to pull back. I mean, it just barely touched the 8 exponential, and then it proceeded to keep moving higher. Earlier in the day, I think we were somewhere just below 11 points when the market sold off. So Apple had not even traded to the average of its typical historical daily price movement range. So when the markets were melting down, Apple barely twitched. It certainly did not flinch. And I think those are the kind of things that we continue to rely on to focus on pullback buys. I'm not going to be as eager to take momentum buys at these levels, of course. Those are higher risk. Those would be buys as the market's crossing some sort of resistance threshold, sometimes a new high. The pullback buys are going to let us take advantage of exhaustion. And that's what I've sort of highlighted here. And that's what we're doing in the room. Not only looking at NASDAQ and S&P trades. We were long as day trades, the S&P and the Dow today. The NAS wasn't that cooperative. And I really don't have that much interest in the Russell right now. But we're still looking long and long only. Think about it this way. I know a lot of folks are waiting for that day that we get the June 11, 12, 15th, or the June 29th pullback. But in the meanwhile, by picking tops and buying puts and waiting for the pullback, which I hope happens, and I think it will, but by doing that, you're actually not buying some of the more aggressive pullbacks in anticipation of a much larger correction. I'd rather miss the correction, buy into the correction, than short the correction. Okay? And it's neither right or wrong. It's the way that I'm going to look at it, because the double green on these daily time frames basically prohibit me from shorting. I'm simply not allowed to short. That's the way in which my rules prevent me from taking what I believe to be a low probability trade, which is shorting a double green instead of saying, hey, let everyone else short it, and I sure hope it works. And it will eventually. But into that, we'll just wait and buy the pullback and think about June 11th, 12th, 15th. Think about June 29th. We've had these opportunities. I think we will again. So let's keep to the long side, both intraday and overnight. Let's wait for that pullback and get opportunistic to buy the pullback, not to take advantage of the short. Okay? Really simple, long bias only, and I'll see you in the next update.